with some analysts predicting that if economic trends are favourable, the FTSE 100 index could rise by as much as 14% to 9,800 points this year. So with this in mind, is now a good time to consider investing in the UK's flagship index. In this video, I'm going to take a look at reasons why or why you might not decide to invest in this index to help you come to a decision that is right for you. Firstly, let's dig a little bit deeper as to what the FTSE 100 index is. And it is often referred to as the FTSE, representing the 100 largest companies listed on the London Stock Exchange by market capitalisation. This means that companies with higher valuations have a greater impact on the index movements. It's a barometer of the UK economy, reflecting the performance of major corporations that are influential not just domestically but globally. Understanding the index composition provides insight as to where the vulnerabilities and strengths of the FTSE lie. And looking at this snapshot chart, it can be seen that financials, consumer staples, energy and consumer discretionary are the largest sectors, with the high growth sector technology only occupying about 2%. Interestingly, although a UK index, over 70% of revenue generated by FTSE 100 companies comes from abroad. This global reach offers exposure to international markets. Companies like British American Tobacco and HSBC have significant operations in emerging markets in Asia and Africa. And firms such as BP and Shell have strong presence across North America and Europe. This international diversification can cushion the index against domestic economic fluctuations, but also exposes it to global risk. The top 10 companies make up a significant portion, nearly 40% of the index total market cap, and the chart shows you some of the heavyweights that significantly influence the index performance, with well-known companies such as AstraZeneca, HSBC and Shell occupying some of the higher places and having the biggest market share. Another UK stock market index called the FTSE 250 focuses on the next 250 largest companies after the FTSE 100. And that 250 index is often more domestically focused, including more mid-cap growth companies. So those patriots seeking truly British companies might also want to check out the FTSE 250 and the FTSE 350 to see what that's all about. So let's take a look at why this could be an opportune moment to invest in the FTSE 100. So the first reason could be attractive valuations. Many FTSE 100 companies are currently trading at valuations that are lower than their historical averages and international peers. And due to its sector composition, the FTSE 100 has a tilt towards value stocks rather than growth stocks. This undervaluation presents potential growth opportunities as markets recognise and correct these discrepancies. Reason number 2, global exposure despite being a domestic index. Although it's a UK index, a significant proportion of the FTSE 100 companies' revenues come from international markets. Some examples of this are pharmaceuticals business AstraZeneca and energy companies Shell and BP, who are all world-renowned. This means that investing in this index doesn't just tie you to the UK economy, but also gives you exposure to global economic growth, offering diversification benefits. Reason 3, currency dynamics favouring multinationals. Fluctuations in the British pound can impact the FTSE 100 companies significantly, and a weaker pound can enhance overseas earnings when converted back to sterling, potentially boosting the share prices of multinational companies within the index. That said, currency fluctuations and the strength of sterling could also be a counter-argument, and currency volatility adds an additional layer of risk, potentially affecting dividend payouts and share prices. Number 4, there's a potential to hedge inflation. With continuing concerns about inflation, equities like those in the FTSE 100 can act as a hedge, as many of the companies have stronger pricing power and can pass increased costs on to consumers, helping to maintain profitability and protect investors' purchasing power. Number 5, sector diversity offers stability. The FTSE 100 encompasses a wide array of sectors including finance, healthcare, energy and consumer goods, which can help mitigate sector-specific risks. This diversity allows for stability, as different sectors may perform better at different times. You will have noted large falls in the S&P 500 this week, as China introduced DeepSeek to compete directly with US AI technology. Although the US S&P 500 index fell by about 1.5% on the 27th of January, the effect of DeepSeek on the FTSE 100 was minimal, and the FTSE 100 ended up being 1 point higher on the same day. And the next reason will be robust dividend yields. The FTSE 100 is renowned for its strong dividend-paying companies. With dividend yields higher than many other global indices, investors can enjoy a steady income stream, which is particularly appealing in today's moderate interest rate environment. Moving on to the next argument, which covers strategic shifts towards sustainability. Many companies within the FTSE 100 are actively shifting towards sustainable and environmentally friendly practices. This not only meets growing regulatory requirements, but also aligns with the increasing investor demand for socially responsible investments. And the next reason is geopolitical stability and new trade opportunities. Post-Brexit, the UK is trying to establish new trade agreements and strengthen international relationships. FTSE 100 companies are expanding their presence in emerging markets, tapping into higher growth rates compared to those for developed countries. This could open fresh growth opportunities for FTSE 100 companies, enhancing their global competitiveness. The next reason is a strong regulatory framework. The UK's well-established legal and regulatory environment provides transparency and protection for investors. This stability can enhance confidence, especially in times of global uncertainty. The next reason is technical advancements. While not traditionally tech-heavy, the FTSE 100 is witnessing increased adoption of technology across various industries, from fintech innovations in the financial sector to advancements in pharmaceuticals and energy. Technology is driving efficiency and opening up new growth channels. This international expansion can contribute positively to their revenue and profitability. The next reason is that the index provides resilience in challenging times. Historically, the FTSE 100 has demonstrated resilience amid economic downturns. Companies within the index have weathered financial crises and adapted to changing market conditions, which may offer some reassurance to the investors seeking long-term investments. And the prevalence of established, dividend-paying companies can make the index more defensive during economic downturns. There are, however, arguments against investing in the FTSE 100. Kicking off with number one, you have economic uncertainty in the UK. The UK economy is grappling with a mix of challenges from sluggish GDP growth to sticky inflation rates. Supply chain disruptions and labour shortages post-Brexit have added layers of complexity. The uncertain economic climate can affect corporate earnings and, by extension, the performance of the FTSE 100 companies. Political shifts, policy changes or tensions within the UK, like debates over immigration, taxation, government borrowing and public spending, can also introduce market volatility and uncertainty. A weakened pound and volatile UK bond market in recent times has shown how jittery the markets can be when new government policy is introduced. The second reason is heavy sector concentration. The FTSE 100, although seemingly diverse, is heavily weighted towards certain sectors, particularly financials, energy and mining. For instance, giants like HSB, Shell and BP hold significant sway. If these sectors stumble, for reasons such as regulation change or volatile commodity prices, the entire index can feel the impact, reducing diversification benefits. The next reason is an underrepresentation of high growth sectors. Unlike indices such as the Nasdaq, the FTSE 100 lacks substantial representation in high growth sectors like technology and biotechnology. If you're eyeing the exposure potential of innovative tech firms to push growth, this index may not align with those aspirations. The next reason is global trade tensions and geopolitical risks. Ongoing global trade disputes or geopolitical tensions could disrupt international operations of FTSE 100 companies. Tariffs, sanctions, or diplomatic strains can lead to unexpected costs or market access issues, which in turn will impact revenues. Whilst Brexit is in the rearview mirror, its repercussions linger. Companies face new trade barriers, regulatory hurdles, and potential talent shortages due to stricter immigration policies. These challenges constrain profitability and growth prospects for UK companies. The next reason is potential interest rate hikes. The Bank of England may hold or raise interest rates to combat sticky inflation. Higher rates increase borrowing costs for businesses and consumers alike, which can slow economic growth and reduce corporate profits. And companies with significant debt might feel the squeeze even more. The next reason is environmental, social and governance concerns. Many FTSE 100 companies, especially in energy and mining, face scrutiny over environmental impact and sustainability practices. Increasing regulatory pressures and shifting investor preferences towards greener portfolios may challenge traditional business models. And moving on to the next is dividend reliability issues. While high dividends are a hallmark of the FTSE 100, they're not guaranteed. Economic downturns or company-specific struggles can lead to dividend cuts, which can disappoint investors relying on that income stream. The next reason is that the FTSE has limited exposure to small and mid-cap growth. Focusing on the larger companies, the FTSE 100 misses out on smaller firms that may offer substantial growth potential. These companies, often more agile and innovative, are represented in different indices such as the FTSE 250 and 350. The next reason is inflation erosion. With inflation being sticky, the real return on investments may be lower than anticipated. If companies can't pass increased costs to consumers, profit margins can shrink, impacting share prices. So who might want to invest in the FTSE 100? The FTSE 100 is known for its high dividend yields, making it a popular choice for those who rely on investments to provide a steady income stream, such as retirees or income-focused investors. On the subject of dividends, Dividend reinvestment enthusiasts will see the opportunity of high dividend yields from the FTSE 100, with those dividends being reinvested to purchase additional shares, thus leveraging the power of compounding to grow investment over time. With a portfolio of well-established companies, the FTSE 100 can be a safer choice for risk-averse or conservative investors, with defensive qualities and an ability to weather economic downturns. Through its UK index, many FTSE 100 companies generate significant revenue from international markets. This global exposure can help diversify a portfolio that may be heavily invested in other regions or sectors and be attractive to global diversification investors. Investing in a FTSE 100 index fund or ETF allows passive investors to gain broad market exposure without the need for active stock selection. This is appealing to those who prefer simplicity and lower management fees. And certain FTSE 100 companies might currently be trading below their intrinsic value, presenting an opportunity for value investors who believe the price of these stocks are due for a turnaround. Investors confident in the UK's economic prospects will have faith in the growth of the UK economy and believe that FTSE 100 companies will benefit from this upward trajectory, although as mentioned before, the FTSE 250 and 350 are more UK company dominated. Investing in the FTSE 100 could align with a strategy that seeks diversification, income through dividends, and growth through both UK and global markets. However, it's crucial to consider your individual goals and risk tolerance. Markets are inherently uncertain, and while the FTSE 100 offers potential benefits, it often comes with risks that should be carefully weighed. Some analysts are advising that investors should exercise caution. Interactive Investor believes that although UK shares are currently undervalued compared to those of their international competitors, global headwinds and slow earnings recovery might limit significant gains. They suggest that the FTSE 100 could see moderate growth, but not a dramatic re-rating. The Motley Fool UK highlights that the FTSE 100's performance might depend on several factors, including global economic conditions, commodity prices, and political developments. They emphasise the importance of monitoring these variables to understand potential market movements. Generally, various analysts note that the FTSE has benefited from a weakened pound and expectation of interest rate cuts, which have supported its performance. However, uncertainty about tariffs and political policies could affect its trajectory. Overall, whilst there is cautious optimism about the performance of the FTSE 100 in 2025, it is clear that external factors and economic conditions will play a significant role in shaping its future. Whether you're drawn by the potential for steady income, long-term growth, or global exposure, understanding your own goals and risk tolerance is key to making investment decisions. Investing isn't one size fits all, it's about aligned opportunities with your financial goals, risk tolerance, and time horizon. So assess your risk appetite. Are you comfortable with the volatility that comes with potentially higher returns, or do you prefer stability? Define your investment goals. Are you aiming for long-term growth, income generation, or capital preservation? Stay informed. Keeping abreast of economic indicators, market trends, and global events can help you make timely decisions. And consult a financial advisor if unsure about anything. A professional can provide personalised advice tailored to meet your situation. Thanks very much for watching.